ETFs are great because not only are they very easy to work with and beginner friendly, but because they have a great reputation for actually being able to grow your wealth slowly over time, which is why experienced investors and beginner ones choose to buy into them. Now, if you're unfamiliar with what an ETF is, then please check out my last video where I talk about what index funds and ETFs are. But in this video, I want to talk about the vast variety of options you have when it comes to picking out an index fund or ETF that you want to buy. Because now that we know what an ETF is, the problem becomes which of the thousands should we invest into? So today I'm going to be talking about some very popular indexes that a lot of ETFs track, as well as some characteristics of ETFs so that you understand what's going on when you buy into them. Welcome to Finance for Everyday People. I'm Jeff Mora, and I'll be teaching you all about your personal finances the way you should have been taught. Before we begin, let's do a small little recap on the definitions from my last video. An index is a collection of investments that you use to measure up your own performance against. An index fund is a fund that buys all those investments. And an ETF is the product that actually holds all these investments and trades like a stock. So now let's talk about these popular indexes, or the ETF categories if you want to call them that. First is the S&P 500. And I talked a lot about this one in my last video. It tracks approximately 500 of the largest US companies. Some examples of ETFs that buy into it are the Vanguard S&P 500 ETF, iShares Core S&P 500, and Spider's S&P 500. Note that these ETFs can be written as acronyms with the following letters, and we call these acronyms tickers. So just to be clear, these ETFs all follow the same thing. They're just different products distributed by different vendors. Next up is the Total Stock Market Index, and this tracks thousands of US companies of all sizes. So instead of just owning the biggest companies, you own almost the entire US stock market. Some examples here are Vanguard's Total Stock Market ETF, iShares Core S&P Total US Stock Market ETF, and the Schwab US Broad Market ETF. Next up are international ETFs, or rather the International Stock Index. And these track companies outside the United States. The reason you might want to do this is because it gives investors exposures to businesses around the world. In my last video, we talked about how you want to diversify to avoid, big risks. And it's the same idea, only you're just expanding yourself not just to what's limited in the US, but to a much bigger and broader environment. And finally, we get into the dividend ETFs. Now, there isn't just one dividend index, and I'll talk more about what dividends are later on in the video, but some examples of this category include the Schwab US Dividend Equity ETF, Vanguard Dividend Appreciation ETF, and iShares Core Dividend Growth ETF. And again, don't be intimidated by the several ETFs out there per category. The big idea is that there are just a few popular indexes out there, and then there are several options to choose from, but you don't need to buy all of them for every category. Now, when you own an ETF, there are going to be a few things you'll need to know. The first thing is that they do cost a small fee. See, when you buy a stock, the only thing you're paying for is the actual ownership of that stock within one company. But with an ETF, because it's a collection of several stocks, because it needs to be put together and packaged nicely, there's going to be a fee associated with it. So an expense ratio is a small annual fee charged by a fund to operate and manage the ETF. What that might look like is I might see an ETF with an expense ratio of 0.03%. What that means is if I have $10,000 invested into this ETF, then every year I would get charged 0.03% of it, or in this case, it'd be just $3. If the expense ratio was 0.5%, then every year I'd pay $50 just to have this ETF. So it should be pretty clear that the lower the expense ratio, the more money that stays in your pocket. Now, another thing to understand is because the ETFs we're mentioning are following indexes, that means they're generally passively managed. And because they're passively managed, it just means there's less work being put in to maintain this ETF. On the contrary, there are ETFs or funds out there that are more actively managed. And all this means is that there's a fund manager who is actively choosing what stocks go into the fund. And because they are constantly trying to pick out winners to go into the fund, it's going to cost more. So passively managed ETFs tend to have a lower expense ratio than actively managed ETFs. Again, for the sole reason that there's someone behind the scenes who needs to work a lot harder to keep up with what's going into it versus just following an index that's an already established list. Another characteristic of ETFs, or stocks in general, are dividends. Dividends are a payment a company makes to shareholders from its profits. A dividend yield is just the percentage of your investment paid out in dividends each year. So if I have $500 invested into a company, and after a year I've received a total of $50 through dividends, then the dividend yield would just be 10%. Typically, dividends aren't paid out once per year. They're usually broken up throughout the year in the form of quarterly payments, monthly payments, or some other schedule. So if I receive $50 for the whole year in dividends, then that typically means I receive $12.50 per quarter. Going back to the dividend ETF examples I gave earlier, one thing you'll need to know is that ETFs and stocks in general are typically one of two categories. There are growth stocks and dividend stocks. And in turn, if an ETF just contains growth stocks, then it's just a growth ETF. If an ETF contains just dividend stocks, then it's a dividend ETF. The difference is growth stocks reinvest their profits back into the company. And because they do this, then what you would hope is that they grow faster. On the other hand, dividend stocks, they pay out their profits to their shareholders more regularly or at higher amounts. But that might mean that they grow less rapidly. It comes down to the company's objective, whether they want to prioritize growing the company or whether they want to just prioritize sharing the profits. To show this, let's look at one common growth ETF versus one common dividend ETF. Let's look at the Vanguard S&P 500 ETF, which remember tracks the top 500 largest companies within the US. So it's primarily a growth ETF. Within the last 5 years, you can almost fit a straight line to show its growth. The share price back in mid-2022 was about $350, and in today, it's almost reached $700. So that's to say that if I invested $100 back in mid-2022, then today I would have $200 in total from that investment. Looking at the expense ratio and dividend yield, you can see that we have an expense ratio of 0.03%, meaning if we had $100 invested into it, then we'd have to pay 3 cents per year. And because we have a 1.05% dividend yield, what that means is if I have $100 invested, I can expect about a $1 payout each year. So the cost is low, and the dividend yield isn't really anything to brag about, but the real power behind this ETF is the fact that I was able to double my investment in the span of 4 or so years. Next, let's look at SCHD, or the Schwab US Dividend Equity ETF. This is a very popular dividend ETF that, again, does not focus primarily on growth, but primarily on paying out its investors with dividends. If we look at the 5-year chart, we can see that for the most part, it's been pretty flat. Only within the last year have we seen some real growth. And again, just because it's a dividend ETF does not mean growth can't happen. All it means is that it's not focused on doing so. It's focused on, again, paying out its shareholders. But in comparison to the Vanguard S&P 500 ETF, we can clearly see that it's been very slow growing. If I had invested $100 back in 2022, when it was about $25 per share, then I'd have about $130 today, now that it's almost $33 a share. When we look at the expense ratio and dividend yield, we see more to the story. The expense ratio is 0.06%, meaning if I had $100 invested, I'd have to pay 6 cents for the year, which is actually double that of the S&P 500 ETF. But when we look at the dividend yield, it's 3.27%, meaning for $100 invested, I get $3.27 as a payout each year. And these numbers might not seem like a lot, but the more and more you have invested, then these numbers really start to add up. If we want to compare apples to apples, we can see that the S&P 500 ETF has doubled its performance within the last 5 years, and although the SCHD ETF didn't do terrible, it grew very slow in comparison. However, it has a much better dividend yield. The fact that we get $3.27 for every $100 invested compared to just $1 with the S&P 500 means that we get more than triple the amount in dividends paid back to us each year. When we do the math out, you can see for yourself which one ultimately had the better gains within the last 5 years. But each year is going to be different. And it's really up to you how you want to divide your portfolio up, whether you want to have more growth ETFs or dividend ETFs. At the end of the day, I suggest you have a little bit of both. And one last side note about dividend ETFs, there's nothing stopping you from reinvesting those payouts. If I receive $3.27 each year from my SCHD ETF, then I can totally just throw that money back into buying more SCHD so that the following year I get an even higher payout. So before you go on and start buying ETFs on your own, just remember these things. You want to understand what's actually in the ETF, like what indexes it's tracking or what companies are in that fund. What are the expenses? How much are you going to pay from the investment each year? The dividends or payouts? How much are you getting in return? And finally, what's its focus? Do you want those payouts to be the ultimate goal of your investment? Or do you want it to grow on its own so that when you do decide to sell, you can flip it for a much higher profit? The last thing I want to call out when it comes to ETFs and stocks in general is that the share price doesn't necessarily mean that the company is doing better or worse. Just because you might have an ETF that costs $50 per share and another ETF that costs $500 per share doesn't mean that ETF 2 is doing better than the first. These are all irrelevant because you can buy fractional shares, meaning if I wanted to put up $100, I can buy $100 worth of ETF 1, which would get me 2 shares, or ETF 2, which would get me a fifth of a share. Regardless, it's still $100 invested into either ETF. We've made it to the end of the video, and we've covered essentially all the basics when it comes to ETFs. So now you understand exactly what goes into an ETF, what the costs and payouts are associated with it, as well as what they prioritize and what you should buy depending on your goals. Remember, don't focus on finding the perfect ETF. Focus on understanding what it is you're buying. Please drop a like on this video, subscribe, and share with a friend who can benefit from learning about ETFs. Until next time, I'll see you.